Good day, guys. Welcome to Forex Walker. Welcome to episode 98. We are about to get to episode 100, where I will be doing live trading. And in those live trades, I will be doing less of teaching macroeconomics. I believe that with 100 episodes, you'll be able to understand the difference between uh, geopolitics, market fundamentals, or macroeconomics, because a lot of people confuse market fundamentals with news trading. News trading is like when you wait for a trading session. What do they call them? When you wait for a market to open from like another country, and you wait for the CPI, the Consumer Price Index, and you trade that consumer price index. That is news trading. Most people call it fundamental trading, but it is not really the fundamental trading. It's called news trading because you are trading a news report or a news release specifically that is released at that time, which normally they love trading the consumer price index, the CPI, and they trade the non-farm payroll. They call it the NFP. So sometimes one or two of them were trading the the balance of trade, or I forgot the other name that they use it for to call it. So those are news traders, and market fundamentals are not really news trading. Their market fundamentals are not CPI. Market fundamentals are not non-farm payroll. So those are market fundamentals are the general outlook of all of the news releases. And you don't wait for a news release, you wait for the month to end, and you collectively look into the macroeconomic. You look for You gauge the entire economy of that country, and you decide whether the currency will go bullish or bearish. But trading a CPI is a news trading thing. So in position trading, we use four things. We use macroeconomics, we use geopolitics, we use we some people call them uh, FOMCs. We use but normally those are just meeting minutes, central bank meeting minutes for different countries, and we listen into what the central bank is saying for each currency, and we make our decisions on whether the currency will go bullish or bearish, and we don't trade when they speak. So those who trade when they speak are the news traders. Though the news traders normally they call themselves fundamental traders, but those are news traders. They trade a few seconds as the central banker is speaking, or the governor, and those are the news traders. So macroeconomics or market fundamentals is not news trading. So I just wanted to clear that up because I'm a position trader and I do position trading. I apologize for speaking for that long, but in this video I'll be speaking to you. Let me just show you what the CAD is doing. The CAD, currently I'm trading a geopolitics trade, which involves the Strait of Hormuz being closed and Canada being an alternative uh, to Europe, and the the Asian, the the South China Sea countries, Australia, Philippines, Japan, the United States affiliates, or the U.S. proxies in the South China Sea, involving South Korea, Japan, Taiwan, Philippines, uh, Indonesia, all of those countries in the south, including New Zealand and Australia. So those countries are getting crude oil from the Middle East in the Iran war and the Strait of Hormuz being closed. Oil is no longer exiting from those areas. Not all of it, but for the countries that are affiliated with the U.S., which is the same thing, meaning they're not getting crude oil. So for that, with Europe going to to Canada, this CAD, I was speaking about it. I think it was moving sideways, and I said it will continue to move higher. That's where I placed this baby over here, where I'm expecting it to get to the take profit level for the CAT CHF, and with this being a CAT trade. Now let's move back to the USD and continue to speak about the things that this is the CMA group or the Fed Watch tool. So Fed Watch tool, some call it the CMA group, but it's the same thing. So what we have here is that previously we had the okay June 2026 is no longer available, but basically we had this. We were pricing in interest rate cuts inside of we were somewhere in the month of March. We are moving toward the end. Today is the 29th of March 2020. I hope you can see my mouse down here. 29th of March 2026. So we had our first interest rate cut in June, and the interest rates moved from June to July, then they moved from July to August, and all of 2026 the interest rates were priced out. Now, the CMA Group, their job is used by futures market traders, those guys who are doing investing in futures, deciding whether a currency will go bullish or bearish long term. Now that is what we do here, which is position trading, and so they ended up pricing interest rate cuts throughout 2026, and the first interest rate cut that is being priced in is on the 8th of December 2027. Now that will be the whole year of 2026. Now this does not mean the central bank will not intervene. The central bank can always intervene in case with so we don't expect the central bank to cut rates, in other words, but they can still intervene by introducing interest rate hikes, by hiking rates in case the inflation grows out of, especially now with the prices of crude oil and all of those things going out of control. So here we have United States inflation rate. It's at the bottom right here. If it drops below the uh, uh, let's say it gets to 1.5%, the central bank will have to intervene. But if it keeps moving higher, especially now, I expect it to move higher because of the high inflation as a result of prices increasing in fuel and all of those things. Now we are running out of time, so this is the core personal consumption expenditure. You can see that we are keep getting those increases, and this is the consumer price index. News traders call it a CPI. So we're still getting those big highs, and over here we have United States consumer price index. We keep getting those highs, and because of that, these are future economic indicators telling us that in the future, we are having a growth in inflation. And because of that growth, we are now pricing in, we are now pricing out because of that growth in inflation, we are pricing out any form of interest rate cuts. So that means it is highly likely that the United States will have to introduce interest rate hikes because we are pricing in the the inflationary numbers, and they're telling us that we keep increasing and increasing, and these are telling you that in the future you might price in a hike in inflation or an increase in the inflationary numbers. So so in other words, we're expecting a bit higher from here, and if we do get, which is unusual, I'm not expecting us to get a bit lower, because it will get a bit lower because of what I had an unemployment rate giving us a bit higher, and I don't believe that will affect the inflationary markets, and unless if we get a bit that is much lower than expected. But at the moment, we're with those smaller economic reports telling us that, especially the personal expenditure, personal consumption expenditure, telling us that it keeps beeping high and high. It's telling us that the inflation is expecting a growth. So it's telling us that the growth in inflation is imminent, and we're expecting such in the future. So with that, that's the reason why the futures market or the Fed watch tool had to price out any interest rate cuts in the future all the way up to 2 years, because here it moved forward by 2 years. In other words, we're expecting interest rate hikes. So what I believe will happen with my research is that we'll get an inflation that will give us something looking like this. We'll get a growth that is growing out of hand, and prompting the central bank or the Fed to hike rates to push back the inflation to the current percentages that you see over here. So those are my expectations, and with the Australian dollar having done the same by increasing interest rates. They were battling with inflation, and they had no choice but to hike rates. Unfortunately, with the current war in the Middle East, uh, there's a high possibility that we'll get a little bit of a collapse in the. In fact, I think we already received a collapse in the Australian dollar, but in the future we will get a pump. But with the pricing in of the issues in the Middle East and the crude oil not going over there, we are really expecting terrible. So growth in the currency of the South China Sea countries will be a little bit slower than expected. Uh, yeah, it will be a little bit slower than expected, but because they're hiking rates, I believe that they might have an opportunity to hold rates, because they actually hiked twice, and to push inflation lower. I believe that. But currently, with the inflation, the inflationary markets in Australia are not really responding to the interest rate hikes, and there's a high possibility that they might introduce another interest rate hike. But I have reason to believe that they're waiting for the pricing in of the shocks as a result of crude oil shortages in the Middle East, and that's what I believe they might be. But they can always forget about the United States, and being allies with somebody does not mean your country should suffer. They can always get Russian crude oil from China, and or they can get Russian crude oil from Russia and push their economy. They don't really need to die just to be an ally with the United States. So I will thank you guys for this episode, and I'll be seeing you on the next episode. You can wait for the releases of those videos of live trading. Thank you guys.